All right, chapter 5, adjusting work entries on the worksheet. So up until this point, we have learned how to journalize business transactions, post to the general ledger, and prepare a trial balance. There we go. So now what we're going to talk about is making end of period adjustments to the accounts listed in the trial balance. So this chapter talks about the need for adjustments, why we do them, and then I'm going to walk you guys through how to make those adjustments, whether or not we have a worksheet. So a couple of things we are covering in this chapter. There we go. So preparing end of period adjustments, we're going to post them to the general ledger. We're going to prepare a worksheet. We'll talk about methods for finding errors on the worksheet. We will journalize adjusting entries from the worksheet. And then there's 3 kinds of accounting that we're going to talk about. So cash, modified cash, and accrual basis of accounting. All right, end of period adjustments. These are changes that affect the business's financial condition. So equipment that wears out, prepaid insurance, and supplies that are being used up. So we've talked about how we can buy $160 worth of supplies, but at the end of the month, we don't have 160 anymore, right? I've used markers, pens, paper, whatever supplies that are there. So I have to go in and I have to adjust it, because if I leave the $160 on my balance, it looks like I have a whole bunch of assets, right? Same thing with vehicles. If I don't depreciate it, it looks like I'm carrying the full value throughout on our books. And so we've got to reduce that. We have to depreciate these things. So equipment, like your delivery of vehicles in the example, those things wear out, like wear and tear. So we depreciate them. We use our prepaid insurance, we use our supplies, and then we've kind of touched on wages payable. So here we're finally going to see wages expense, wages payable. So employee earning wages that have not yet been paid are called wages payable. Okay. The company owes that money to the employees, but it's not time to pay them yet. We've still set aside the money in payables, right? So since these events have not been entered into the accounting system, we have to do adjusting entries. So transactions are entered as they occur throughout the year, and we make adjustments at the end of the accounting period for items that don't involve exchanges with an outside party. Now, adjustments are guided by 3 principles, and we've talked about the revenue recognition principle a couple of times, right? Revenue is recognized when it is earned, regardless if the customer paid you cash. Remember, we saw like received money for services on account, and we still recognize that whole amount as revenue, even if they haven't paid us yet. Let's see, the expense recognition principle. So expenses are recognized when they are incurred, regardless of when cash is paid. So this is where we're going to see wages payable and wages expense. Okay, so whenever my employees earn wages, it increases my expense. But if it's not time to pay them, I have to put it in payables. Okay, so we've seen wage expense and cash. Those are the 2 accounts because we're paying them. He had like 2 part-time employees and he paid them $650. And so he was paying them cash right away. So now what we're going to see is they're earning the money, but it's not time to pay them. So you have to affect at least 2 accounts. So we have wage expense increases and my payables increase because I'm waiting to pay them, right? The matching principle, the proper matching of revenues earned during the accounting period with the expenses incurred to produce the revenues. This is our best measure of our net income. So why do we adjust the trial balance? Well, we have to report all revenues that are earned during the accounting period. We have to report all of our expenses. And then, like I said earlier, we have to accurately report the assets on the balance sheet, right? I don't have that prepaid insurance policy 2 months from now isn't going to be worth $1,000. Now it's only worth $800. Okay. To accurately report liabilities on the balance sheet. So my wages payable, right? That's a liability. A fiscal year is a 12-month period. We talked about this in an earlier chapter. It doesn't have to be the same as a calendar year, but businesses schedule their fiscal year to end when business is slow. So for here at SCI, I've talked about our fiscal year is July 1st through June 30th. All right, so let's look at adjusting supplies. So during June, Mitch purchased supplies for $80. So that's an asset account that increases on the debit side. But when he goes back and he looks at the supplies, he's only got $20 left. So how much did he use up during the month? If I start with 80 and I end with 20, how much did I use? 60. Yeah, that is the most math we're going to do here. Okay. I like to look at this screen. It's a little bit easier to see. So my supplies, you can see my trial balance is $80. And then it tells us we ended with 20. So your homework, you're going to have to figure out that $60 adjustment. Okay. So when we adjust or reduce the balance on a asset account, we have to put it on the credit side. Okay. So it tells us 80 minus 60 is 20. And now two accounts are always affected. So the supplies expense account is going to increase by $60. All right. So your homework is going to look very, very similar to this. You're going to have T accounts that you fill in, and then you're going to go to the general journal. Okay. And so for your general journal, debits are always listed first. So the account that was debited is the supplies expense. Your credit account was supplies. It was an asset. It decreased on the credit side. Okay. Is that making sense? Yeah. Okay. So if I'm putting this on the balance sheet, my asset of supplies is only $20. Okay, it's not the 80 that we saw earlier. Now my expenses on the income statement, my supplies expense would be $60. Remember, I have that in there. All right, so let's talk about expired insurance. So Mitch paid $700 for a 10-month liability insurance policy. So if it is $700, and it's supposed to last me 10 months, I'm going to divide 700 divided by 10 gives me what? 70. So every single month, he needs to decrease the value of that asset by $70. Again, I like looking at this chart. So my trial balance was 700. I'm reducing that asset on the credit side by $70. So now my prepaid insurance is only worth $630. Okay, it's not worth $700 anymore because a month has gone by. Now on the other side, my insurance expense has to increase on the debit side by $70. And then again, for your homework, you're going to have to put a general journal entry in. So the insurance expense account was debited. You guys can see that right here. And then my prepaid insurance is an asset and it decreases on the credit side. So that account gets listed second. All right. So we're taking everything we've kind of learned so far, and now we're just kind of adjusting those at the end. So if I'm looking at my balance sheet, the prepaid insurance, its value is only $630. It's not $700. If I'm looking at the income statement, my expenses increased by $70. Okay, for the month. So let's look at unpaid wages. Mitch paid his part-time employees $1,650 on June 27th. So between June 27th and June 30th, they earned an additional $400, but it's not time to pay them yet. Okay, but we have to recognize that money. All right, so here's what that looks like. So my wages payable is a liability account, right? Like our accounts payable. So we increase that on the credit side by $400 because that's what I owe them and I'm going to pay them later. But we recognize wage expense when it happens, even if I haven't paid them. That was that matching principle we talked about, right? So my wage expense increases by $400. So I've paid them $1,650. I owe them 400. So my total wages for the month is $2,050. Okay. So looking at my journal, my wage expense goes first because that was a debit entry, and my wages payable goes second because it was a credit entry. Okay. As we do the homework, as we talk through it, it'll get easier. But if you get lost, come back to the book. All of these are straight from the book. All right, so my balance sheet, my wages payable would increase by 400. And on my income statement, my expenses would now be the full $2,050. All right, so getting into depreciation here, assets are recorded at their actual cost, and that remains on the books as long as the business owns the asset. So we don't make changes in the market value of the asset. We do have something called useful life, which is the period of time that an asset is expected to help produce revenue. An asset's useful life expires as a result of wear and tear, and if it no longer satisfies the needs of the businesses, expenses should be recognized and the value of the asset should be reduced over its useful life. So this is where we get into depreciation. We depreciate the asset. We are going to use the straight line method. The appendix for chapter 5 has a lot of different methods for depreciation. And if you're really excited about that, you can go check it out and learn a little bit more, but we're just going to talk about straight line. So the salvage value is the expected market value or selling price of an asset at the end of its useful life. So the depreciable cost is the original cost of the asset minus its salvage value. For our homework, all of your assets are going to have a 0 salvage value. Okay, I'm going to show you an example right now. So straight line depreciation example, Mitch has motor scooters and he believes that they're going to be good for 5 years. They're not going to have a salvage value after that. And the original cost of all of them was $4,800. So because the salvage value is 0, the whole $4,800 needs to be spread out over the next 5 years. Okay. So the 5 years times 12 months gives me how many months? 4,800. 5 years times 12 months. Because we're going to depreciate this month by month. Months. 5 years times 12 months is 60 months. Okay. So my straight line depreciation for all of these motor scooters is going to be $80. So 4,800 divided by 60 months. Every single month, I'm going to reduce these motor scooters by $80. Okay. Is the value carried on the books in the accounting records, the original cost of plant assets minus accumulated depreciation. It doesn't represent the market value or selling price of the asset. We are going to see accumulated depreciation. It's a contra asset account. Contra just means opposite. It has a credit balance, which is the opposite of an asset, and it's deducted from the related asset account on the balance sheet. So we're going to see delivery equipment is going to have a depreciation expense. And now we have a new account called accumulated depreciation for the delivery equipment. So let's see what that looks like this chart. So as you see over an asset, I have my delivery equipment of $4,800. But now I have an accumulated depreciation for the delivery equipment, and that has an adjustment of $80. On the other side, I have a depreciation expense for delivery equipment, and that increases on the debit side. So when I put them in my journal, the debit goes first, right? My expense goes first, and then the accumulated depreciation goes second. All right, a straight line depreciation adjustment. The same concept is used on the balance sheet. The difference between these accounts is known as the book value of the delivery equipment. That just means what's carried on the books in our accounting records. So let's look at the effects of adjusting entry for depreciation for July. So if no delivery equipment is bought or sold during the next month, the same adjusting entry would be made at the end of July. So we're saying $80 for 1 month, $160 for 2 months. Okay, that's what this is trying to tell us. If an income statement for the month of July had a balance sheet as of the 31st, the figure 511 would be reported for the delivery equipment. Okay, so here we have 2 months of depreciation, and then we see that just in the income statement, we only recognize 1 month as the expense for that month. I don't think this stuff is in the homework, but it's still important to understand. All right, we have an expanded chart of accounts. We've got to have new places for all these accounts. So 185.1 is accumulated depreciation. We now see wages payable, and now you have a supplies expense, insurance expense, and a depreciation expense. So you may have to open the chart of accounts to get the full name for your journals. All right, when we post adjusting entries, it's the same as posting other entries, except we're just putting adjustments or adjusting in the item column. All right, so your homework is going to look a lot like this. We're going to have the journal. I think problems 5 and 6 look like this. You are going to be given the adjustments at the top, then you're going to put them in a journal, and then you're going to put them in their individual ledgers. Okay, so there is some scrolling up and down, but it's not so bad. It's not like chapter 4 was. Okay, so what we see is I'm looking at my supplies, my general ledger. I had my trial balance of 80. I'm putting my adjustment, I'm bringing that down. Remember that decreases on the credit side. So I'm bringing that asset down by 60. So I'm showing now that my new balance for supplies is only $20. Okay. My supplies expense, that's going to be the only entry, is the $60 in there. So prepaid insurance is the same thing. We put them in their individual ledgers. Right. So it started off with a balance of 700 for prepaid insurance. I brought that down by 70 because I did 700 divided by 10. So bring it down by 70. So my new value for prepaid insurance is $630. Right now, on the other side, all I'm going to do is recognize the insurance expense. I'm going to increase that by $70 here. Okay, it'll be the only entry for a lot of them, so you'll just kind of scoot it over. And here's an example for wages and then our delivery equipment. So if you get stuck on your homework or the assessment, go back to the book. These pictures are straight from the book. So it gives you an example of where things should go. All right, the worksheet. We put together all the information needed. It's not a financial statement. People will usually prepare it as an Excel spreadsheet. It's not a formal part of the accounting system. The accountant uses a worksheet. It's helpful in planning adjustments and preparing financial statements. It is commonly in a 10-column format. It's got 5 pairs of debits and credits. So let's look at that. I like to look at the image. It's a little bit easier to kind of wrap our heads around. So in the first column, we have the trial balance. So that was the 470 in cash. That's what we ended with. We can see supplies there for $80. So we put everything into the trial balance. Then we put our adjustments in. So here we only had 4 accounts that had adjustments, right? The supplies, the insurance, the delivery equipment, and the wages. So you'll see adjustments up on top, and then you'll see some on the bottom as well. Okay, because then we had the expense accounts for them. So put in the trial balance, post the adjustments there. Then what you're gonna do is you're gonna calculate your adjusted trial balance here. So cash, receivables, those things didn't change. So you just move them over, okay? It is things like supplies that have a new balance, right? So I had 80 minus 60 is 20. So this is my new trial balance. So when I do the math, I've got to make sure at the bottom that they match, right? All right, the income statement. Now remember, income statement is revenues minus expenses, right? So here for income statement, I'm gonna leave all that blank. I'm just looking at revenue minus expenses. For the balance sheet, I'm making sure that everything balanced out. So I put everything else in up at the top. All right, so at the bottom of the last slide, we are going to learn net income apart, net loss together. So the balance sheet columns of Mitchell's worksheet show total debits of $12,020 and total credits of $7,380. So the difference of $4,640 is our net income. We're used to seeing it just in the income sheet, but now we're seeing it in a little bit different format. So the amount is credited to the column, is added to the credit column to balance the balance sheet. If the business had a net loss, then we would put that in the debit column. So once we make this entry, then everything will balance out, okay? So if it is a net income, we put them apart. If it is a net loss, we put them together, so they will balance out. All right, finding errors on your worksheet. If any of the columns don't balance, make sure you find the error before you continue. All right, so there's a lot of checks and balances in accounting, making sure the numbers were entered correctly, making sure everything equals what it should. So journalizing our adjusting entries, the worksheet helps the accountant organize the end of period financials. These accounts aren't adjusted until a general journal entry is made and posted to the general ledger accounts. So let's look at what that looks like. All right, so when we put them in our worksheet, right, so our supplies here, I have my trial balance and my adjustments. And then we looked at the general journal earlier, right? After we did the T accounts, we were posting them to the journal and then posting them to the ledger. So again, if you get stuck, look back in your book. All right, so talking about the different types of accounting here, the accrual basis of accounting offers the best matching of revenues and expenses. It is required by GAAP. You guys remember from chapter 1, GAAP is the generally accepted accounting principles. The GAAP financial statements prepared using the accrual method are important when you're trying to raise large amounts of money. Investors and creditors, so banks or people who want to invest, they want GAAP financial statements, and they're not going to lend you money unless you are following GAAP. So you have to be using the accrual basis of accounting. Now, in this one, revenues are recorded when we earn them. Expenses are recorded when they are incurred. That's what we've seen over and over here. It also has receivables and payables, right? People who are going to pay me and people who I still need to pay. It's the best matching of revenues and expenses. Now, you can also have a cash basis of accounting. So revenues are recorded when cash is received, but expenses are recorded when cash is paid. So similar to the accrual basis, if there are few receivables, payables, and assets, this can vary significantly if the business has a lot of receivables, payables, and assets. So I like a good chart, so let's look at this. So under the accrual basis, if these transactions are for a company, I've got $10. When I look at everything, all right, I've got my revenue minus my expenses. I'm showing that I still have $10. If I look at the transactions for this company under the cash basis of accounting, I'm in the hole 250, right? I'm negative 250 there. It's because we're not recognizing revenue when it was earned, and we're recognizing expenses when they're paid. Okay, that's the big difference here. All right, we also have the modified cash basis. It'll combine aspects of the cash and accrual methods. A business uses the cash basis for reporting revenues and most expenses. Exceptions are made when cash is paid for assets with useful lives greater than one accounting period. All right, let's look at an example of this. So under the cash basis, right, we did services on accounts, but I can't recognize them. So all I can recognize for this month is that I had to pay somebody, I had to pay my research assistant $50. So it looks like a negative 50. Under the accrual basis, I can recognize this as revenue, and then I record my expenses, and I am in the positive for 440. Now, under modified cash, I can't recognize what is it called? The revenue when I earned it. I gotta wait till they pay me. But I recognize office supplies that I used and paying my research assistant. So I'm in the whole $60. Okay. All right, the book gives us this chart for comparing cash, modified cash, and accrual methods. All right, and then chapter 5 appendix is our depreciation methods that I talked about. We are only going to use straight line. We are not going to go into any of these others, but it can be exciting. I remember when I took accounting, there was one, he talks about double accelerated depreciation if you're trying to write it off a little bit faster. And I thought that was pretty cool. So if you are interested in learning more about depreciation methods, it is out in chapter 5 appendix. Any questions?